Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into SoundThinking Inc., that's SSTI. And this is a company, it's undergoing a really dramatic transformation right at the intersection of, technology and public safety.
It really is. And the core conflict here is it's so stark. SSTI is betting its SafetySmart platform, and $20 billion TAM expansion will unlock a 40% long-term Adjusted EBITDA Margin, justifying a high-growth valuation despite an unremediated material weakness in controls and a Q3 guidance decimation that revealed acute sales execution risks.
That sets the stage perfectly. For a long time, if you mentioned SSTI, people only thought of one thing.
ShotSpotter.
Exactly, ShotSpotter.
Yeah.
The company, which formally changed its name from ShotSpotter Inc. to SoundThinking back in April 2023, is aggressively trying to escape that single product identity. So our mission today is really to understand, have they actually done it? Have they successfully transitioned from being just a domestic acoustic gunshot detection provider
Into this platform company.
Yeah, into the global diversified SafetySmart platform company they claim to be.
And that identity shift is so key. But, the mechanics of the business, they're fundamentally the same. The revenue model is, at its heart, a recurring SaaS subscription structure.
A very lucrative one.
Very. And critically, they derive substantially all of that recurring revenue from local governments. So cities, states, municipalities.
Right, which introduces a whole other layer of risk.
It absolutely does. This reliance on public funding brings in a level of political and budgetary volatility that your traditional B2B SaaS company just doesn't have to deal with.
So they are tied directly to the political and, the financial health of city councils all across the country.
Yeah.
Let's maybe look at the suite of tools they're offering now.
Right.
Because it's not just the original flagship anymore.
Not at all. The original product, ShotSpotter, is still the marquee name, of course. It's that outdoor gunshot detection system, and it's known for giving law enforcement alerts in approximately 45 seconds.
And that speed is everything.
That speed is their core value proposition. As of the end of 2024, they reported that the system covered over, 1,076 square miles.
That's some impressive scale. But it's the recent acquisitions that really define this platform shift. What are the major components in this new six-tool ecosystem?
The most important one recently has to be SafePointe. This is their newest addition.
Okay.
It's an AI-based weapons detection system. They acquired it in August of 2023. And unlike ShotSpotter, which is sold by the square mile, SafePointe is sold on a per-lane basis.
And it's growing fast.
Very fast. As of December 31st, 2024, they reported having 277 lanes under contract.
And SafePointe is really their entry point into completely new verticals, right? They also have these investigative tools aimed squarely at data analysis for police.
Exactly. Crime Tracer it's maybe the most powerful data component. It's essentially an investigative search engine.
So let's law enforcement search through, over 1 billion records.
Over 1 billion criminal justice records. It's this massive information aggregator designed to help agencies, connect the dots instantly.
Then you have the other tools, Case Builder for case management and Resource Router for patrol deployment. They're also subscription-based, usually priced by the number of sworn officers.
Right.
So the big takeaway here is they've successfully broadened their footprint. They cover everything from crime detection to investigation and resource allocation.
And if you connect this to the bigger picture, that name change, SoundThinking, it isn't just a marketing gimmick. It's a real statement that their ambitions have outgrown that original product. They're trying to be an essential infrastructure provider for public safety data.
Okay, let's talk about growth then. Expanding the product suite is one thing, but that expansion has to translate into a much, much larger market opportunity to justify a growth stock valuation.
Mm-hmm.
What are the key drivers for that new market size?
The market size expansion, that is the core argument for the stock. The acquisition of SafePointe in August 2023 was the single most defining transaction.
Why that one specifically?
Because it immediately launched SoundThinking into the estimated $20 billion weapons detection market. That's a huge strategic pivot away from only relying on police budgets.
And here's where it gets really interesting for anyone betting on this stock. SafePointe has found what they call an extraordinarily strong product market fit in the hospital vertical.
And the biggest tailwind driving this demand isn't just standard security budgeting, it's regulatory.
Right. It's a mandate.
That's the critical piece. We're talking about California Assembly Bill 2975, or AB 2975. This bill requires all general acute care and psychiatric hospitals in the state to implement automated weapons detection systems by March 1st, 2027.
So a regulator is essentially writing a multi-billion-dollar check to this market segment. It's guaranteed, legislatively enforced demand, which is incredibly rare.
It's a captive sales lead.
And we're seeing proof of concept outside of California, too. I know management highlighted a recent deal, a 26-lane project with a Florida hospital.
Which shows the demand is spreading organically. It's not just constrained to that California mandate.
Right. They also went after market expansion through partnerships, not just buying companies.
Yeah, in July 2024, they partnered with Rekor systems for PlateRanger. That put them right into the massive automated license plate recognition, or ALPR, market.
And that's a market valued at what, about $3.2 billion?
That's the number. So the strategy is clear. Acquire the product, enter a massive new market, and then you leverage these legislative tailwinds to speed up adoption.
But this expansion requires a lot of internal strength, and our sources show they are aggressively investing in R&D, especially in AI.
And the AI investment is really twofold. First, they're enhancing the product. You see that with CrimeTracer Gen 3 for better search. But the second internal application of AI that tells you everything you need to know about the risks they're trying to manage.
What do you mean? Tell us more about that.
They are implementing what they call agentic AI in their customer success applications. You should think of this specialized AI as a kind of political early warning system.
A political radar.
Exactly. It scans and analyzes political and social data. It's looking through city council meeting minutes, local news, social media sentiment, and it tries to predict if a city is about to challenge a contract or if a renewal is going to get delayed.
Wow.
The fact they have to build that into their operations just underscores how fragile their core government customer base really is.
That is a fascinating insight. Spending R&D just to combat political instability. Which brings us directly to the recent financial performance. Because the growth story sounds great, but the actual results were a major wake-up call.
Oh, they absolutely were. Q3 2025 results exposed severe sales execution challenges, and the market reacted violently. Management had to significantly slash 2025 revenue guidance to approximately $104 million.
And they cut margin guidance, too.
They did. They reduced their Adjusted EBITDA Margin guidance to a pretty concerning 14% to 15%. That is a drastic cut. It signals some significant operational weakness.
And what was the cause? The sources point to 3 big high-margin contracts that were delayed.
Proving just how volatile that government sales cycle can be, even for renewals. The first was a delayed high-margin renewal with Puerto Rico, valued at $1.4 million. This deal just unexpectedly required a formal RFP.
A request for proposal.
Yes,
Right.
Which is a major procedural hurdle that, frankly, management should have seen coming. Secondly, they lost the timing on a highly profitable multi-agency statewide CrimeTracer deal. That was worth $2.5 million.
So that got bogged down in bureaucracy.
The complexity of dealing with multiple government agencies at once. And the third delay highlights their global ambitions and the risks that come with them.
That was the deal in Brazil.
A large CapEx shot spotter deployment in Brazil, another $2.5 million value, which just hit unforeseen delays. So these 3 deals totaling $6.4 million, it's all high-margin revenue that just evaporated from the quarter's forecast.
But doesn't this point to a fundamental failure in sales execution? I mean, if you're an established company, shouldn't you be better at forecasting these bureaucratic delays?
That's the core skepticism the market holds right now.
It seems less like bad luck and more like flawed pipeline management.
I think that's fair. The short-term pain is very real. Their Q2 2025 GAAP gross margin was only 53%, and the immediate EBITDA margin guidance is 14% to 15%. And yet, management still holds on to these very ambitious long-term targets of a 70% gross margin and a whopping 40% adjusted EBITDA margin.
So they're asking investors to completely ignore the current reality.
Purely. Bet on the projected scale and efficiency of the SafetySmart platform years down the road. It's a massive leap of faith, especially when you look at the company's financial runway.
Right, that accumulated deficit.
An accumulated deficit of $110.9 million as of September 30, 2025. That means over their entire history, they basically burned through all their capital just trying to build this platform. They aren't just trying to grow, they are fighting for time.
Okay, so we're shifting from execution risk to structural risk.
Okay.
And this is where the picture gets acutely dangerous.
Yes, the loss of the Chicago contract in 2024, which was 11% of their Q3 2024 revenue, that loss severely amplified their concentration risk.
That exposure is now dangerously acute. Our sources show that the city of New York accounted for 28% of total revenues for the 3 months ended September 30, 2025.
28%.
You're looking at nearly a third of the company's business resting on the political and budgetary decisions of a single customer. If New York City has a change of heart, it is an existential threat to sound thinking.
And if that high concentration wasn't enough, we have to talk about the persistent internal control issue. Management identified a material weakness in internal control over financial reporting back in 2024.
And it's still there.
And critically, it remained unremediated as of September 30, 2025.
So for our listeners who aren't, corporate auditors, what does material weakness mean in simple terms?
It's not a minor accounting error. It means the financial plumbing is leaky. There are potential flaws in their systems that could lead to a material misstatement of their financial reports. So the potential for fraud or significant error.
And the fact that it's unremediated is a huge governance flaw. This issue becomes even more pressing soon, right?
Correct. SoundThinking will become an accelerated filer effective December 31st, 2025. This means they transition from self-reporting their controls to being subjected to SOX 404B, which requires an external auditor to officially attest to the adequacy of those controls.
So pressure's on.
Immense pressure on management to fix that material weakness immediately, or they face serious compliance issues and, much higher audit costs.
And finally, we come back to that political instability that underpins every single sale. Their entire revenue stream is susceptible to major political swings. You see it with movements like defund the police and just negative publicity.
The political risk is omnipresent. They have bid on a new Chicago contract RFP, but there is zero guarantee they will win it back. That initial non-renewal showed exactly how swiftly local politics can shift funding away from their solutions.
So we have a company with its explosive strategic potential entering these $20 billion markets balanced against just severe operational and governance flaws. What's the ultimate decision for the investor?
I think the core investment decision is this. Does the massive strategic potential, that $20 billion TAM expansion from SafePointe, buoyed by the hospital mandate, and the long-term promise of a 40 per thousand EBITDA margin target, does that justify making a high-conviction bet on sound thinking right now?
You're betting on the future.
You are betting on the materialization of future platform scale.
Or do the structural issues, the unremediated governance risk, the repeated significant sales execution shortfalls that just decimated their Q3 guidance, and that growing $110.9 million accumulated deficit, do those things render the stock a high-risk gamble entirely reliant on management converting its pipeline into revenue flawlessly?
Risk defined, portfolio protected.